Alrighty, so for you guys that are here and newbie, we're this is Grid. I'm the leader of the Grid Delco chapter. Grid's a we're gonna go into that a little bit, but it's a global network of real estate investors. And this week or this month, we're gonna focus on how to save on taxes, build a fortune with 1031 exchanges. So this is you your goal is to build up to a point that you can snowball and wrap some properties together, sell them, take the equity, and go buy something bigger, right? When you hear people say that, what they mean is a 1031 exchange. You're exchanging one property for another or a like kind asset, which Tina is going to get into. Um, and to me, it's when you start doing this is when things really start to click. Everything you do before, like all of the work you do beforehand, is uh, to me, all of the work you do beforehand when it comes to building up your real estate portfolio is all just building a foundation. Once you're able to start packaging and moving up, putting down larger down payments, buying stronger properties, that's when you really start to see a return. So understanding 1031s, how you can use that to your advantage, is super important. I wish Bill and Beth were here, but they are newer investors. They bought a property during COVID and Poconos, early in COVID 2020. They sold it last year for a nice return before things changed too heavily when it came to the market shift, and they didn't know about a 1031 exchange. So they took a hit. They paid capital gains on it. Now they were still made out okay, and they're now doing their first borough locally, and they're very happy and all that stuff. But they could have saved a lot of money if they had exercised this. So it's important to know this now so you could plan for when you get to that point. So just so you know, Grid is a global real estate community built for investors, by investors, not gurus. We're a group of real estate people doing deals. I had to, interview for the position to purchase this market for Grid, and essentially you have to be an accredited real estate investor or someone heavily in real estate. You have to know what you're talking about, right? So, and to me, that's the biggest thing. A lot of people buy a couple properties. I'm not really a fake it till you make it guy. Like I got to the point where I did 20 burrs and 20 flips before I started even teaching seminars about investing. So, and that's kind of what they look for when they bring their market leaders in. So, our mission is to connect, learn from, and collaborate with like-minded people interested in building wealth and creating impact through real estate. Uh, a few of the people here and some of the people that came to my first seminars, like I'm helping them do flips, helping them do burrs. I'm investing with some of them. Like that's, I'm not I'm not big into syndication. I'm not trying to go that big that fast. I don't even know if I'll ever do that. I think I like small partnerships where it's me and a family member or me and a friend that are on the same page and we can actually own the asset versus I see syndication as another job, right? Like I'm working for my investors, and when I'm the owner operator, or at least have it with someone that's at a similar level to me, it just feels like less of a job and more like an investment. So don't get me wrong, syndicators make a ton of money. They're not most of them, not a lot. A few of them are doing it very well and understand what they're doing. But for me, it's just about finding people, on my level or a little above or a little below that I can make things work with. Mm. So, like I said, we welcome investors of all experience levels. I consider us lifelong learners and believe everyone has value to share. I'm constantly trying to learn about real estate, if it's from my sales business to just building businesses to investing. I'm always listening to some sort of podcast or ebook because I'm always on the go. So the idea of sitting and reading a book is kind of foreign to me, and I don't even know if I could read anymore at this point. But um, yeah. Uh, so Grid's getting big. They, have over 1,000 Grid communities, 2,000 leaders. They've made 10,000 people financially free through real estate investing, and a lot of millionaires. Who am I? I am William Holder. I run the William Holder Realty team, as well as the Classic Realtors powered by Real out of Wayne, Pennsylvania. I have 20 agents, 10 years. Well, I've been in the business 13 years, but I've been full-time 10 years as a real estate agent. I've done about 1,000 transactions. I've done about 20 flips and 20 bursts personally. And um, uh, I run this group because, like I explained, I'm trying to meet like-minded individuals that are learning and understanding how to invest in real estate and want to do the same thing I'm doing, as well as if they have deals they want to bring to me as well, because it's a good way to find investment properties is talking to people off market. So with you, I want you to just eat up as much free information as you can. It pains me to hear when people pay for real estate investment seminars and things like that nature. Most of this information is free. I've never paid for a seminar in 13 years of trying to learn about real estate investing. It's all free out there. It used to be YouTube, now it's podcasts and ebooks. Don't get me wrong, I'm sure there's some value to it. People pay for it, but I just think if you're willing to go a little bit extra, you can get this stuff for free. And free, that's the best way to get. I'd rather you use your money to invest in real estate than to pay for a course about investing in real estate. And if you want to, I want to accomplish just teaching you how to invest in real estate, helping you build your portfolios, helping you learn about investing in real estate the right way, the smart way, the correct way. I'm not I don't enjoy being the idea of being a slumlord. I don't enjoy any of that stuff. I think if you're going to be a good investor, be a good investor. If you're going to do a flip, do it right. If you're going to buy a property and manage it, do it right. Don't buy it and run it down and make people's lives miserable because you're trying to make extra money. That's really not for me. How can you connect with me? Will at williamholderrealty.com or William Holder Realty at William Holder Realty on Twitter, Instagram, the William Holder Realty team on Facebook, kind of everywhere. So yeah, my phone number cell is 610-657-6215. All right. So before we let Tina go here, let you guys introduce yourselves. Let us know a little bit about yourself. We'll start with everyone in the room.
My name's Dominic. Hello, you guys. I have a small property maintenance business in Folsom. It's food and cleaning, got a very high level of everything. I work with a couple investors, along with Foster, kind of all over the place. So just here to learn and maybe network a little bit. Can't hurt.
Awesome.
Hello everyone, this is Girish here. I've been coming here for the last about 7-8 months. I became an agent last year and started investing for ourselves. And then in the process, I'm helping clients to buy some of the properties. So I'm learning a lot from Bill for sure. Maybe I think. Awesome.
I'm Hannah. I have a couple of properties in California and Stockton, a little bit of this slumlord thing. I have a property manager and I wanted to learn a bit more about 1031 exchange because after 10 years, I'm ready to sell in different places. It's just
Locally now?
yes, I do. So I have one place I'm renting out in Pennsylvania. The one I want to sell is in Stockton.
Okay. Awesome.
My name's Chris. Just bought my first 2-unit last August. Looking to buy hopefully another property in the next couple of months. I'm also working on getting my real estate license to sell as well. Just trying to learn as much as possible and like everybody else, network and build relationships.
What it's all about, man.
Yep.
Gotta network. Somewhere.
Awesome. All right. So now that we've done that, some important legal stuff. Don't sue me. All right. This is all free. Do with it what you will. I'm just trying to help you out, Just so you know, I do record these and I put them on our YouTube page, just so people have content. So if your voice is being recorded, I'll say anything stupid, you know what I mean. All right, cool. So we're gonna let you get started over here. So I'll let you share your screen if that's okay.
Yeah, here we go. Let me pull it up. And let's change this. All right. Okay, do you see the screen?
1 second. There you go. You're up.
Okay, wonderful. All right. Thank you, Will. Happy to be back at, this is my third grid presentation, so I appreciate the opportunity. My name is Tina Pashovich. I'm the Regional Sales Executive for Old Republic Exchange. We act as a qualified intermediary for 1031 exchanges. That's our specialty. And today I'm going to go over a Cliff Notes version, a very basic version of the 1031 exchange. So we're going to go over the rules and regulations and talk about the many benefits to you as an investor. I always say the 1031 exchange is the real estate investor's best friend. So if you are unfamiliar, I'm about to introduce you to your new best friend. What is a 1031 exchange? It's simply the code designated by the IRS that provides that a taxpayer may sell property and defer payment of any capital gains tax if that taxpayer uses the proceeds to acquire like-kind replacement property. So a couple of terms to pay attention to. The taxpayer is deferring payment of their capital gains tax. They're kicking the can down the road, so to speak. But you will see that there are substantial benefits to that tax deferment. And then the other term we'll talk in a bit more detail is like kind. Essentially, we are referring to any type of real property held for investment purposes. Specifically, the code states that no gain or loss shall be recognized on the exchange of property held for productive use in a trade or business or for investment if such property is exchanged solely for property of like kind. So again, must be held for either productive use in a trade or business or for investment. 1031 exchanges are for investment properties only, not your primary residence. Another little tidbit, they've been around for over 100 years, so this is not a newfangled approach. However, the guidelines were refined in the early 90s, and those are the guidelines, rules, and regulations that we abide by to this day. I always like to mention too that sometimes when you hear of a tax code or a tax break, oh, this just must be for that wealthy real estate investor or that top 1%. In fact, 1/3 of all 1031 exchanges are for properties less than $500,000. And we see exchanges all the time for properties held for less than $100,000. You can still have significant capital gain on a property that you're selling for $100,000. So again, this is a tax strategy utilized by real estate investors at all levels. And in order to qualify for this tax treatment, again, deferring that capital gains tax, the IRS requires that specific rules be followed by the taxpayer. And again, those rules are set forth in the 1991 Treasury regulations issued by the IRS. Essentially, a 1031 exchange is IRS speak for swapping one property for another property with the services of a qualified intermediary, that necessary middleman in the process of exchanging properties. Why would you do a 1031 exchange? First and foremost, capital gains tax can be substantial. It can oftentimes be a shocking number. You have to take into consideration the federal rate, which is typically 15%, sometimes 20%, depending on your income. Then you have to add your state tax, and depending on your income, you may have to tack on an additional 3.8% for the Medicare surtax. So this can oftentimes be upwards in the 20%, 25%, sometimes in the 30% range. So again, capital gains tax can oftentimes be a shocking number. So rather than paying Uncle Sam, you can use your own money in essence. Reinvest that money into a replacement property. Perhaps you want to purchase a more expensive property or multiple properties. So the idea is to defer your capital gains tax, use your own money in essence to build up that real estate portfolio and possibly real estate wealth. And as we know, most of the wealthy millionaires and billionaires have achieved their wealth through real estate investing. Another benefit, transfer to an income producing property. Perhaps an investor owns vacant land, they're holding that, it's appreciating in value, that's great. Well, you could sell and exchange into a type of property that's generating rental income. So you could exchange vacant land for a duplex, for example. Also, it allows the investor the ability to diversify and minimize risks to that real estate portfolio. What do I mean here? An investor can exchange into residential real estate, commercial real estate, so different classes of real estate, and also anywhere in the United States is considered like-kind property. So you can diversify geographically as well. So those are a few of the reasons to consider a 1031 exchange. Let's look at some numbers. Let's compare. Let's say you are selling your primary residence. You purchased that in 2018 for $300,000. You sell it a few years later for $500,000. Your gain is $200,000. Well, there is that primary residence exclusion, right? If you file single, you can exclude up to $250,000. If you file jointly as a married couple, you can exclude up to $500,000. So there's no capital gains tax in this example. Now, let's say we use the same numbers, but it's an investment property. It is not your primary residence. Well, you have a capital gain of $200,000. That is the figure you're going to attribute those percentages to. So again, your federal, your state, the Medicare surtax. So if we use 30% as an example, which is not an uncommon or inflated percentage to use as an example, you have to pay Uncle Sam $60,000. So of that $200,000 that you thought you were going to pocket as profit, you have to pay $60,000 to Uncle Sam. So it almost seems unfair, right? So we're going to talk about the benefit of a 1031 exchange, but there's a very important concept in a 1031 exchange, and that is the equal or greater concept. In order to defer 100% of your capital gains tax, you want to roll all of your proceeds into a replacement property equal or greater in value to the sales price of the property you're selling, minus certain customary closing costs. Realtor commissions, for example, can lower that value a bit. But for our conversation's sake, I'm going to keep the math easy. If I'm selling a property for $100,000, if I wish to defer all of the tax, I need to roll all of my proceeds into a new property that's at least $100,000. If I find my dream property and it's $90,000 and I do not wish to purchase additional property, I can do that. That's a partial exchange, but you'll be on the hook for the taxes for that difference of $10,000. It's also important to note that any debt, any mortgage debt that you have on the property you're selling, you must replace that with equal or greater debt as well on your new property or bring fresh cash to the table. And that is so you meet that equal or greater concept. So again, there's an example here on the slide, but I like to keep the math easy. Again, if I'm selling for $100,000, I want to purchase a property that's at least $100,000. Some of the terms you'll hear today, the relinquished property or RQ, that's the property being sold in the exchange, the replacement property or RP, the property being acquired in the exchange. We're going to talk about that identification period. That's the 45-day period following close of the sale of that relinquished property, in which the taxpayer is required to list in writing possible replacement properties. We're going to go over the exchange period. That is the 180-day period following close of the sale of that relinquished property, in which the taxpayer must complete the acquisition of the replacement properties. And we're going to touch upon the G6 restrictions. That is the specific section of the regulations that state when an exchanger is entitled to receive proceeds. One of the critical functions of a qualified intermediary is to hold and control the funds. What are the rules? Well, the first rule, the property being sold and purchased must be held for investment. Again, primary residences do not qualify. You must use a qualified intermediary. That's what we do. The qualified intermediary provides what the IRS refers to as safe harbor, right? We are that neutral middleman in the process of exchanging properties. The exchanger may not have actual or constructive receipt of the exchange proceeds or during the exchange period. So what this means is if I have sold an investment property, closing took place, and I do not have the exchange set up, but let's say it was not even an in-person closing, and the check is on the title agent's desk or the attorney's desk. I've never laid eyes on it. I certainly haven't cashed it. Well, let's say the next morning I decide, you know what, I do want to roll all of that money into a replacement property and defer my taxes. Well, at that point, it is too late. That's because you have actual or constructive receipt. You have access to those proceeds. Even though you haven't touched the money, they are there ready and waiting for you with your name on it. So that's what makes rule number 4 critical to a successful exchange. The exchange agreement must be entered into on or before the closing date of that relinquished property. The exchange has to be set up prior to closing. We like a 48-hour notice. However, we have received calls from the closing table, and more often than not, we can get that set up fairly quickly. The 5th rule, the taxpayer must identify in writing potential properties that will be the replacement property in the exchange. The identification must be done within 45 days of the closing of the relinquished property. And finally, rule number 6, the taxpayer must complete the purchase of the identified replacement property or properties within 180 days of closing of the relinquished property. These are 2 critical, important deadlines in a 1031 exchange. So the 45 days to identify and a total of 180 days to close. How many properties can I purchase? What are the rules of identification? How many properties can I purchase? The first rule, and perhaps most utilized, is the 3 property rule. This is where you can identify up to 3 properties regardless of their values. You could end up acquiring 1, 2, or all 3 of them, depending on what your strategy is. But again, if I'm selling a property for $100,000, I can identify 3 properties and each can have a value of $10 million. There's no maximum value. The other rule is the 200% rule. If you identify more than 3 properties, so 4 or more, you can do so as long as the combined fair market values do not exceed 200% or 2 times the value of all the relinquished properties. So again, for the sake of easy math, if I'm selling a property for $100,000, I can identify any number of properties as long as those combined values do not exceed $200,000. Now, let's say you've identified more than 3 properties and the values exceed that 200%. Well, the exchange has a chance of surviving, but it's very risky. So if you identify more than 4 and you're beyond that 200%, that falls under the 95% exception. This is where any number of properties without regard to value can be identified, provided that 95% of the value of all the identified properties are acquired. Imagine you've identified 6 or 7 properties. Well, to achieve that 95%, you'd have to close on all of those properties. So it's important to be aware of the values and try to fit into that 200%. That 95% exception is very aggressive and very much prone to failure. When we set up an exchange, we send the exchanger an identification form with instructions. We ask them to select the one of 2 rules, either the 3 property rule or the 200% rule. You fill that out, you write down the addresses, and you send that back to the qualified intermediary, again, within that 45-day timeline. So let's take a look at that delayed exchange timeline. At 0 days, close of the first relinquished property. It's not unusual for an investor to sell more than one property and combine those into one exchange. You can do that, but you have to be mindful that the clock starts ticking at the close of that first property. You then have that 45-day window, and these are calendar days, to provide identification, written identification of potential replacement properties within those identification rules we just talked about. And then you have a total of 180 days to close on your replacement property or properties. If you're purchasing more than one, you can do that, but they all must close within that 180-day exchange period. These are very strict timelines. These are guided by the IRS and the Treasury. As a qualified intermediary, we are powerless in the department of granting any sort of extension. We are bound by these very strict timelines. So that 45th day ends at midnight on that 45th day. So if you are closing on September 12th, the calculation begins the next day, the 13th. If same with the 180th day, if your 180th day happens to fall on a weekend or holiday, you need to be aware of that and close prior to that weekend or holiday. So again, with these timelines, these are calendar days. So it includes weekends and holidays. A good qualified intermediary will make you aware of your dates and send you reminders, but ultimately it is up to the taxpayer to be aware of these dates and be sure to follow these timelines. There are 4 methods of exchanging. The first and most utilized is your standard delayed exchange. That's where you're selling your relinquished property, and then within 180 days, you complete the purchase of your replacement property. There's the simultaneous exchange. That's when the closings happen on the same day. You can do that, but technically the property you're selling must close first, so in the morning, and then your purchase. With the delayed and simultaneous exchange, contracts are assigned to the qualified intermediary. The qualified intermediary does not take title. It's still direct deeding, but the contracts are assigned. And roughly a fee for these types of exchanges ranges anywhere from $950 to about $2,000. And the reason I mention that is because that's quite a contrast between the next 2 types of exchanges I'm about to discuss. Number 3, the reverse exchange. It's exactly as it sounds, it's just in reverse order. The purchase of that replacement property occurs before the sale of the relinquished property. The same timelines are in play. Now, this is a good option if the seller or exchanger has found a property they wish to purchase that they do not want to miss out on, or perhaps they're under contract, they're obligated to make that purchase, and they have not yet sold their relinquished property. Well, you can only do that under the context of a reverse exchange. And the reason being is the exchanger cannot own 2 properties at once. So with a reverse exchange, it's much more complex, more expensive. The qualified intermediary jumps in and holds title to one of the properties in the exchange. More often than not, it's that replacement property. So the taxpayer has access to the property, but they have that 180 days to complete the closing of the property that they're selling. Because the qualified intermediary jumps in and holds title, there's much more risk. It's just a much more complex process. Fees for a reverse exchange, again, to provide you a bit of contrast, are $8,500, and you will be responsible for multiple closing costs as well, because we need to convey title back to the exchanger. Having said that, depending on what your capital gains tax looks like, that $8,500 might still be worthwhile. Then finally, the construction or improvement exchange. This is where you're selling that relinquished property. You use an exchange accommodation title holder, again, to acquire and hold that replacement property. So the qualified intermediary jumps in, holds title to that replacement property, while proceeds are used to construct improvements. Upon completion of those improvements, that replacement property is conveyed back to the exchanger. An improvement exchange is a good idea if, for example, you sell a property for $500,000 and you find a fixer-upper that's $250,000. To meet that equal or greater principle, you have that extra $250,000 to make up. Well, you could use that towards capital improvements, but again, only under the construct of that improvement exchange. Again, the exchanger has access to that property. They act as the manager. They are going to send the contractor's invoices directly to the qualified intermediary, and then the QI will pay the contractor directly. And that is so the exchanger, again, does not have access or touch the funds during the exchange period. Construction exchanges are $9,500. Again, you will have multiple closing costs. But again, having said that, depending on what your tax looks like, it could still be worthwhile. What qualifies as like kind? What in the world does like kind mean? It's a very broad and liberal term. Essentially, any type of property that is held for investment qualifies. So if you have a single family home that's not your primary residence that you're renting out, for example, you can exchange that for a multifamily. You could exchange vacant land for a strip mall. Perhaps you want to change up your business model and exchange a hotel for a farm. So the physical characteristics do not need to be identical. You can exchange residential for commercial. And again, anywhere in the United States is considered like kind. So again, like kind, very broad and liberal term. You do not need to exchange a duplex for a duplex or residential property for residential property. Essentially, again, any type of real property held for investment purposes can qualify. All right, property excluded. Boy, I'm often the bearer of bad news for this first one. Any stock in trade or other property held primarily for sale does not qualify. Exchanges are for properties held for investment purposes. Well, what does that mean? How long do I need to own a property for it to qualify as an investment property? The IRS does not clearly state that. They look at a number of factors, but having said that, most CPAs recommend a minimum 1-year hold period. So I often get a call from a flipper asking if they would qualify for a 1031 exchange, and more often than not, they are not, right? The intent is to get in there, fix it up really quickly, get it out onto the market as quickly as possible. So again, flips are held primarily for sale versus primarily for investment. Dealer lots is another example of property held primarily for sale. Any bonds or notes, any securities or evidences of indebtedness or interest. I'll back up a little bit. REITs, real estate investment trust. That's another question that I receive often. That's considered as security or stock and does not qualify as real property. Interests in partnerships. Partnerships can exchange, but problems arise when one of the partners wants to drop out and go on their merry way and leave the partnership, and that is a problem due to the same taxpayer rule in a 1031 exchange. Whoever is on title to the relinquished property in the exchange must be how title is acquired on the new property. So if Joe Smith is on title to the relinquished property, Joe Smith must be on title to the replacement property. If ABC Partnership is on title to that relinquished property, ABC Partnership must be on title to the replacement property. Any certificates of trust or beneficial interest, I like to call all of this paper promises. Any paper promises is not considered a real property. If someone has an action against your property, that's going to be an issue. And personal property. I mentioned nothing's really changed since the early 90s except for personal property. Prior to the tax changes in 2017, you could exchange farm equipment, for example, that you used for your business, or airplanes is another example. You could exchange that if you were using it for your business. But in that tax act, personal property was limited. So again, 1031 exchanges are only for real property. I mentioned the vesting. Again, the same taxpayer rule in a 1031 exchange is critical to a successful exchange. When we set up an exchange, we ask for a copy of your vesting deed and the title commitment to verify who in fact owns the property so that we are setting you up for a successful exchange. So if Joe Smith is on title to the relinquished property, again, he must acquire title to the replacement property. Well, what if Joe Smith is now married and he wants to add his wife to title on the new property? Well, that's an issue. The IRS will look at that as a 50% gift, and 50% will be taxed at the capital gains tax rate. So again, critical to know the proper vesting in a 1031 exchange. I touched upon partnership interest. Again, partnerships can exchange. There are strategies to use. You can drop out of that partnership into a tenant in common interest. That way, each individual can do what they wish, but you want to do that as far in advance of an exchange as possible, preferably a year out for the exchange. Having said that, we've seen partnerships break up a week before the exchange. That is the exchanger's risk to bear, because essentially when you're dropping out into that TIC, the ownership period starts over. Even if you've owned that property for 20 years in that partnership, as soon as you drop out into that tenant in common interest, that ownership period starts over. So if you use an exchange within a few weeks, if you're to be audited, they may look at that as not having held that property for investment purposes. Repair work, we always review the settlement statement prior to closing. Any funds used for repair work would be taxable boot, so it's best to bring outside funds for that. And the easy way to remember this is any amount not exchanged for like-kind replacement property will usually be deemed taxable. Related parties. Related parties can exchange with one another, but they're highly scrutinized. Related parties must hold on to their respective properties for a minimum of 2 years. If my mother owns an investment property, I can buy that from her. I have to hold on to that property for a minimum of 2 years. And get this, my mother has to use an exchange into another investment property, hold on to that property for a minimum of 2 years. And the reason the IRS enacted these rules, related party rules, is so that family members could not shift their bases, therefore avoiding taxes. So very, very strict related party rules. Any non-exchange related costs, prorated rents is a biggie here. If we see that on the settlement statement, we'll bring that to your attention. And again, that pesky holding requirement. How long do I really need to own a property for it to qualify? There's a few things that go into helping to make that determination. Most CPAs recommend a 1 to 2 year holding period. So in a nutshell, benefits of a 1031 exchange, you're deferring your capital gains tax. So rather than paying your taxes, you can use your own money, leverage those dollars for wealth building, right? You can buy a more expensive property or multiple properties and build up that portfolio. You can relocate your assets geographically and also with classes of real estate. And it's a fantastic estate tax planning tool. If my mother has an investment property and she passes away, I'm the heir to that property, I receive that on a stepped up basis. So if I were to sell that property right away, I would not have to pay capital gains tax. If I hold on to that property for 5 years, for example, and then sell, I pay the taxes only on those 5 years. So again, it's a great estate tax planning tool. What does a qualified intermediary do? Well, it is required by the Treasury that you have that middleman in the process of exchanging properties. We handle all of the paperwork. This includes the exchange agreement, the contract assignments. We are not permitted to give tax advice. We can share guidelines, but again, we are not tax advisors. We always suggest that you contact your accountant or CPA, but we're happy to consult with your exchanger's tax advisor. We execute the closing documents as principal. So this means the seller in that RQ closing and as buyer in that new property closing. And one of our critical functions is to hold the exchange proceeds to prevent that exchanger from either actual or constructive receipt of the funds, coordinate with closing agents, real estate agents, tax and legal advisors. And finally, I'll leave you with this. you have to do your due diligence when selecting a qualified intermediary. There are a handful of reputable companies, but there are far more out there online that are not so reputable, and there is a history of fraud in the industry. So you want to look for a company typically tied to a larger bank or a larger title company, because that can assure you that they are financially secure. So obviously a company that's in compliance with the code, a financially secure company, and an experienced company. Old Republic Exchange parent company, Old Republic International, has close to $25 billion in assets. The slide's a bit outdated. You must also make sure the qualified intermediary has insurance and that they can prove it. We have a $50 million errors and omissions policy and a $120 million fidelity bond covering any acts of dishonesty or fraud. And that happens to be the highest in the industry. And that is something that we have earned. It's not something we pay for so we can brag that we have the highest insurance. That is something that we've earned due in part to our parent company, the financial security of our parent company, Old Republic International. My information, my email address. We have a great website, oldrepublicexchange.com. There's a few handy videos. We have a library with subject articles on reverse exchanges, improvement exchanges. There's a do the math calculator. So if you want to punch in some numbers to see what a sale versus an exchange looks like, that's a handy tool. But that concludes my presentation. I'm happy to answer any questions. I'm gonna have to stop and share. There we go.
That was awesome, Tina. Thank you so much.
That's my pleasure.
Any questions for Tina?
Would mobile home parks be excluded?
Would mobile home parks be excluded?
That is an excellent question. So, mobile home, the entire park typically qualifies. What would not qualify would be a mobile home itself that is not affixed to a permanent foundation. If you have a mobile home that is affixed to a permanent foundation and they are paying real estate taxes, that would qualify. But that's an excellent question. Typically, the mobile home park would qualify as a property in a 1031 exchange.
Yeah, because usually mobile homes are technically vehicles.
Okay.
They're sold with a VIN number versus a deed. So
Exactly. Yeah.
it's not exactly a property.
Gotcha.
Yeah. Anything else? No? Awesome. Well, Tina, thank you so much, guys. I've recommended Tina to clients. She's been involved in one transaction we did as a group as well. And I'm going to be doing another one this year with her. So personally could say they're awesome to work with. She's a true professional and I always thank her for doing this.
Thank you, Willem. I appreciate it.
All right. You have a great day.
Thanks. Take care.
All righty. So a few things I wanted to add to that, which Tina won't share because obviously she's not a tax person, but yes, you have to exchange into an equal or greater property. However, if you don't, you can do a cost segregation to reduce your tax load, right? So one thing we're doing right now is I have a package of 25 units in Carbon County, PA, that I have built up over 5 years. It's 7 properties, 25 units. It does okay for me, but because I've refinanced over the years and I had to pay flood insurance in a couple of them, and just some expenses are higher than I want them to be, it's just okay. What I'm going to do is sell them, take the equity, put a large down payment on a smaller property, cash flow more, and do a cost segregation study to reduce my tax impact from that exchange. So you could have a company come out, do a cost segregation. It's not cheap. It could be anywhere between $2,000 and $5,000, depending on how many properties, etc. But what a cost segregation is they go through and they take every aspect of the building and account for that value and depreciate it for you. And they depreciate it at a forced rate. So they're basically accelerating the depreciation of the building up front. I think it's a great product, and I do think that more people, when they're buying investment properties, should do cost segregation studies within the first year or two, because you want to get that early on. You don't want to get it too late into owning the property.
So cost segregation study, can you do them your properties, just only for old properties?
No, you could do it on newer
New
properties.
construction, new
Yeah,
construction.
because basically the write-offs you get from owning an investment property are, the government says, hey, the useful life of that roof is 25 years. The useful life of your plumbing is 27 years. The useful life of your HVAC is 10 years. So every year they're dividing that up, and that's the write-off you're getting.
Right.
All the cost segregation is doing is pulling it and charging it up front, essentially. So if you know, with the plan we have, and obviously talk to an accountant about this, but the plan we have, you know, I'm probably, that package is worth like 2 million, maybe 1.8. We're going to take all the equity, which is equity we've earned through the Burr method, but it's been hard earned. Like, it's, you know, I have to buy these properties, I have to fix them up. They're 1.5 to 2 hours away. It's years of turning tenants over and dealing with issues and investing in the building. These weren't easy transactions. Forced that equity, created it, and now I'm going to take that, put a large down payment on a smaller property. Might only be a 10-unit building. I'm going from 25 units to 10 units, but I have such a large down payment. My cash flow is going to be probably triple what I'm getting right now. And to me, that's the most important. When you're a new investor, it's about cash flow, right? And you might not get it right away, but 5 years in, you better be thinking, okay, when are these things going to start cash flowing for me? So you can get really creative with it.
So with this big beautiful bill, I think 100% of bonus depreciation.
Yeah.
Okay.
Yeah, I've heard a lot of things. I don't know which ones are gonna stick, but I have heard a lot of things. I also heard they're planning on allowing you to put real estate investments in your 401k,
Yeah.
which is another thing that's coming. So we'll see. I mean, we'll see what sticks, but yeah, as of right now, there's some benefits to that.
For the cost segregation study, who does it?
I have someone on my phone. Yes, I have not done one myself yet. This will be my first time, but I did get referred to a reputable company. Yeah.
And so that's like, I guess any real estate tax professional can do that, right? The cost segregation?
No, it's not a tax professional. It's almost like an appraiser.
Oh, okay.
So they go out and appraise and come up with, it's a pretty involved thing to do. So you do need someone that specializes in it. But yeah, it's more of an appraisal than a tax
Gotcha.
person. Yep. So that's a kind of like a little hack, you know, they'll help you. Don't have to keep going up. It's not monopoly. You don't have to keep scaling up and waiting for this to pay off eventually. You can scale back a bit and make it work. The other thing, and she mentioned this, and it's huge to know, I get this from every newer investor, it's not for flips, right? They are, you know, a lot of new investors think you can do a flip, and now could you do a flip, let it take a little bit longer, you know, charge some rent on it over a year or two, and eventually, if the value of that flip is worth it. But usually most flips, you're not making that much money on. And if you hold a flip for a year, you're losing money, right? Especially if you borrowed to do that flip. So there are some investors who get creative, but it's rare that it would make sense to do that. Um, uh, she also mentioned that you have to exchange the property, and the ownership has to be the same. So I'll give an example. One of the properties I purchased with a partner, he was doing a 1031 exchange. I helped him sell a property in Canada, and he was using the money to invest with us. His LLC that he sold the property with did the 1031 exchange into a property that we purchased using his LLC and our LLC. So we were able to combine, and each LLC had 50% ownership, and he still was able to do his exchange. But in the end, we both ended up owning 50% of the property, right? So you don't have to just go from your ownership to your ownership. As long as the ownership of that LLC that he used to sell the property stayed the same into the new property, that was okay as well. And Tina's company was actually the one that did that one. So just a few things I wanted to add on top of that presentation.
So would it be a problem, like, so for example, my property that I bought to my name, it's not an LLC, but let's say 5 years from now, I sell it, it's worth more than what I bought it for, I gotta pay taxes on it, but I use the exchange, I have an LLC open, can I still do the exchange even though the property's in my name?
No, it have to stay in your name.
Damn.
Yeah.
Okay.
Which is fine. I mean, you're still getting the benefit of not having to pay the tax implication.
Could you start an LLC and sell to the LLC?
Yeah, but then you pay a transfer tax.
Is
For-
it high?
It depends on the area, but in our
Might
area,
benefit in the end,
it might. Yeah, if
selling
it's
to the LLC, it's a separate
yeah.
entity.
Well, the other thing to consider is if you have a loan on it and you sell it to the LLC, that can trigger a callback, that the bank could call that loan back because they would want the LLC to take out a loan to buy that property.
Right.
So you'd probably have to do it in like some sort of a trust almost, which you're getting really complicated there. I think if it's just a basic property, just keep it and put it. It's okay to have a couple properties in your name as long as you're running them right, the LLC is to protect you from liability if you're a good landlord and there's no issue with properties.
Okay.
But
So can you give that example again? You said it's on an LLC, but then you can exchange with another one? But she said it has to be same, right? The ownership has to be same.
correct. So if Joe Smith owns Joe Smith LLC, when he exchanges it to another property, it's gotta be Joe Smith owning Joe Smith LLC buying that property. But Bill's LLC can buy it with Joe Smith's LLC.
Oh, they can?
Partnership.
They could partner, right?
Doesn't carry the first one.
Correct, but they're two separate entities still buying it, right? So the building is actually owned by two LLCs now, not just.
You gotta add it, you added someone on. essentially.
Correct. Yeah, now you're not adding that person to the original LLC. You're buying it with two
With
separate LLCs, right? So the title will actually say the name of both LLCs.
Okay.
That's interesting, yeah.
Yeah.
Different than what she was explaining.
Yeah, and it's not, I mean, it's she, I'm gonna shut down the Zoom.